Good morning, everyone. Thanks for making the time to be here. Today, I'm just providing a quick presentation on the performance of our balanced growth fund here at Securities as of December 2022. I want to make this like an open discussion rather than a straight reading of results. I think, if you guys have any questions, feel free to reach out to my email. Um, and yeah, I'm basically just going to walk us through what happened with our portfolio, um, how we can move on, and what you guys should expect from me as investors and our fund. So our fund we launched in January 2017, and over a 5-year horizon till now, our goal was to optimize our Sharps ratio, construct that portfolio, with the goal to achieve an annualized return of over 10%. So with diversification across all the 11 sectors, our goal was to have balanced, like a balance of defensive and growth holdings. But I'm going to walk us through what actually happened here. On the right, you can see this pie chart is all of the holdings that we found to be optimal. But obviously there were some constraints, and we're going to unpack that a little bit more. So here I've provided for you guys just a list of all of our holdings and our sector allocations for the stocks. Walking through our portfolio, like we focused on a couple market leaders, Amazon, Microsoft, and then we tried to incorporate some defensive stocks, say like Coca-Cola with consumer staples. We wanted to hedge with materials and industrials, really focusing on the growth in tech over the 2017 horizon. Unfortunately, our portfolio, we did find disappointing returns. There was limited growth. Um, our defensive stocks underperformed, and we mainly believe this to be due to the fact of COVID-19 and the very, very changing market dynamics. So as you guys are aware, COVID-19 was a massive hit to us all. From 2017 to 2019, our equity markets were on a steady climb. The US government the economy was expanding, corporate earnings were strong. We could see great growth in our portfolio, and the tech and consumer discretionary sectors that we had represented in our portfolio ultimately performed pretty well. But then came COVID, and it was one of the fastest and most severe drops in equity markets since 2009. Real estate suffered, lockdowns and physical retail spaces closed, and all the US government implemented things like the CARES Act to try and stimulate a rapid recovery in the economy. The Coming up to just now, before 2022, the inflation pressures have been building. Consumer prices have started rising sharply. Consumer, supply chains, there's strong demand and high commodity prices. So here I've actually collected a graph for you guys, and this is from the Bureau of Labor Statistics. Going from 2019 to 2022, here you can see that consumer price index in the US has risen substantially. As mentioned before, this is all because of the supply chain bottlenecks and all the lockdowns, which the inflation is going out of control. Something I would like to highlight here is our portfolio reached a peak around January 2022, and then obviously this crash towards the end of COVID. So on the surface, you can see a lot of red numbers here, but our portfolio only dropped 1% compared to the S&P 500 at 5.4. Now, while our portfolio has not recovered since, we believe that it's going to recover over time. At this point in time, we're talking about January 2022 now. So this is very recent, we saw that materials, energy, consumer discretionary, and information tech all suffered significant losses. However, our industrials rose approximately 7%. So we this is a key takeaway here. It's like while our diversification across sectors like has limited our overall um, net losses, it hasn't been enough. We haven't been generating enough returns with our portfolio. Here, I'd like to highlight a couple of things. Um, Most importantly, our Jensen's Alpha for each security. Um, Obviously, so Microsoft has posted an alpha of 0.12, and that's a strong indicator of excess return. What Jensen Alpha does for us is it basically um, provides an estimate of how our stock performed based on our previous estimates. So, we had ExxonMobil, we had 3M and Simon Property Group, all with extremely low Jensen's alphas, and it basically just says it tells us that these underperformed compared to our expectations, and in a very significant way. These are high Jensen's alphas, and we should have managed this risk properly and diverted our resources into other sectors. Over our full horizon, I'm just going to highlight this for you. You can see in January 2022, our portfolio did indeed reach its peak. And coming to the end of COVID-19 now, we can see that these inflationary pressures are still putting a heavy burden on our portfolio. Now, I'm going to move towards a recommendation, but I just wanted to highlight that we did actually have a very low variance portfolio, and we're making sustainable growth over time. But we believe that the allocations that we could have made could have generated us more growth, and we're not particularly happy with how this portfolio has performed. Looking at our average monthly returns, you can see that our securities did give us net positive returns each month on average. However, I would just like to highlight that this does not tell us a whole lot. This this figure isn't representative of the contributions that each security made to our portfolio. And in some cases, there was just little to no return. So this average carried all the way through our investment in a security and didn't generate us the growth that we were hoping for. Here, I'd just like to highlight our major contributions. So obviously, you've got Amazon there and Microsoft. You can see slightly volatile, but obviously increasing over time. And I'd just like to highlight our other stocks here. I've got a main focus on Simon Property Group. You can see there January 2020. That is the start of COVID-19 and the fall in real estate. This is something that we should have managed better. But as you can see, it was delivering us no returns, and then has fallen in value and has remained at that rate. In terms of Amazon and Microsoft, you can see they've reached these peaks and gradually fallen over time as the inflationary pressures have increased. Uh, the economy doesn't have the money to pursue these, and the cost of borrowing has definitely increased. I'd just like to unpack this in a little bit more depth by highlighting you our best performing stocks, and then I'll go into our worst performing stocks. But our investment in Amazon had a total 18.82% gain. On the right, you can see the volatility of these returns. Very, very volatile, leading through to 2022, just completely slumped. It was obviously a clear beneficiary of the pandemic economy, but its margins have fallen leading in, like coming out of 2021 and the COVID-19 pandemic. So we're going to have to reconsider our position in these securities. Google, a total of 14.4% gain, and Microsoft 7.83. We believe that the allocations in tech, um, consumer discretionary, communication services, and information tech in this time where everyone was locked away. Obviously, that's why these have performed the best. But we do note that these were very volatile investments, and we were lucky to have um, good defensive holdings in place. However, I would like to highlight that some of these defensive holdings did not perform the best. Um, Obviously, I highlighted the case of Simon Property Group. That should have been managed better by us, but these delivered us constant losses. But we're thankful that they weren't extreme losses, but gradual. But JP Morgan, it showed lots of, like, the 2.6 loss was represented by the market perceptions during COVID-19. Um, in an environment of slowing growth, obviously, like, there's going to be less demand for loans. Um, with Exxon, there was extreme volatility in oil markets overseas, and it was, obviously, we had a bit of a crash. Um, you can see XOM there on the right has rebounded a little bit, um, while the economy's coming back to life. But um, Johnson and Johnson, it's largely underperformed because of the investor concerns over um, product lawsuits and growth compared to other healthcare names. I believe we could have better, coming into COVID, we could have selected a better stock to represent healthcare that um, might have yielded us a greater return. Moving on, I'd just like to talk about the performance of our portfolio as a whole. So we had hoped for a 10% annual return, or greater, and we had predicted that our expected return was going to be approximately 13.39% each year. However, obviously, we haven't been doing that quarterly rebalancing. While our diversification through all the sectors was efficient allocations, we found that our underperformers did have a minimum 5% allocation of our capital, and that minimum investment that we required in those stocks has seriously limited our capacity for growth. Um, if we had selected stocks which could have yielded us high returns, were more attractive, we we could have improved our Sharps ratio. We could have improved, reduced standard deviation. But obviously, we construct this to maximize our Sharps ratio given those constraints of a minimum 5% allocation and a maximum 20% allocation. Um, I would like to seriously recommend not moving forward. I would like to propose that you give us a chance to consider some new securities. Right now, I would like to hold on to our current position. So I would not recommend selling. I would not want to charge you guys any finder's fees or anything like that, any management fees, nothing. I believe that we are in a good position now to honestly buy more, but reconsider our positions and investments after the crash of 2022. Um, I believe as the economy recovers, we're going to be seeing much better returns. We're going to see, hopefully, our portfolio come up higher than our maximum in 2022. Sorry, what was that? It was February 2022. But yeah, if we were going to move forward with this same weightings with our current portfolio, we'd expect to achieve a return of 8.6 annually. Something that is not good enough for us. We want to reconsider our position, but hold on to what we've got right now. Moving forward, yeah, I just wanted to highlight this one last time. Um, you know, I think that for us here at J Securities, we believe that we need to rebalance this portfolio completely. We need to lock in the gains from our technology sectors. Um, we hold our current positions and allow the macroeconomic environment to stabilize. But I think if we started a rebalancing schedule starting next quarter, if we don't decide to act today, it's going to be we're going to give our portfolio time to breathe, let the economy restabilize, re-enter the market, hopefully in strong positions. Um, I would like to guarantee you guys my full um, cooperation with this project, and the team we are very shocked by what's happening in the market right now. So thank you for your trust. Thank you for your time. That's the J Securities Balance X Growth Fund.